This is part 4 of Green Marker's series on trust. And this is where we get into the juicy examples and strategies and really the pièce de résistance of how we can help you. In previous videos, we talked about what are trusts, the taxes, estate planning pieces. Where I want to start, Hadilia, is how can a family practically use trusts to reduce their taxes?
That is the question. So you have to first realize that there's a set of income tax rules called the attribution rules. There's also a set of rules called TOSI, which is tax on split income rules, that effectively prevent a person from reducing his or her taxes by shifting income to family members. But having a discretionary family trust is actually one solution that tax planners use to help families. And the way to do that is by having a loan go from a person in the family to the family trust.
Okay. And how do you decide how much that loan is?
Well, let's talk about the parameters first.
Okay.
So first of all, you need to set up a discretionary family trust. It's called discretionary because the beneficiaries are not entitled to receive a set amount of money or a percentage of the investment income. And it's up to the discretion of the trustees to decide when to distribute and whether to distribute to them and how much. The second part is that you have to lend personal funds to the trust. So it has to be from a human being's earnings. And since it's a loan and not a gift, the attribution rules would not apply. And then there are other rules for the loan to be considered clean. The first is that the loan has to pay interest at the prescribed rate. Prescribed means set up. So CRA sets up prescribed rates 4 times a year. And currently, we're talking in December 2020, January 2021, they're as low as they can be. They're 1%. So the loan has to be paid back at 1% interest from the trust to the person who lent it. And the borrower, i.e. the trust, pays it back within 30 days of year end. So recall that a trust has a year end of December 31. So by January 30th of the following year, the trust has to pay back the interest, which is currently 1% on a loan.
Wow, that's great. And so those are the parameters around it, kind of getting into the question of what value, what's the appropriate amount?
Yeah, so I think you're asking how much should you loan to the family trust? And I think I can answer that by working backwards. So you have to work backwards to come up with a number. For example, if you have one beneficiary, you have a daughter and she goes to independent school and she needs $40,000 for her education, then the average portfolio yields, let's say 5%, and you have to pay back the lender 1%. So that means you need $1 million to generate $40,000 of income that you can then pay for the education of the beneficiary.
Okay, great.
Shall we go through an example together?
Yeah, that's what I was going to say. Please.
Sure. So let's go with that $1 million example. So here's an example using $1 million loan to the trust. So here are a few assumptions. The first is that the prescribed rate on the loan is 1% and that the trust earns 4% on the investment portfolio, which is a really low rate of return, but we're being conservative in this example. And we'll assume that your marginal tax rate, you're the person who lent the funds to the trust, the parent, and you live in Ontario and your marginal tax rate is approximately 54%. So if this portfolio, this $1 million portfolio is directly held by you, then the investment income would be $40,000 and the tax amount would be $21,600. If this portfolio is held by the trust, then the investment income would also be $40,000. But since the trust would pay you back $10,000 in income, that's the prescribed rate, and you would add $10,000 to your income, the net taxable income to the trust is $30,000. And the taxes payable by your daughter, who is receiving this payment, her school is actually receiving this payment, would be 0. and the taxes payable to you on the $10,000 would be $5,400. So the net tax savings are $16,400 per year. And if your child goes to school for 10 years, then it's nearly $165,000 by the time your daughter graduates high school.
Wow.
So yeah, and obviously the savings are amplified if the portfolio returns are higher or if the trust borrows a larger amount. And keep in mind that at a certain point of earnings, which is approximately $48,000 per beneficiary, the beneficiary would start paying tax. Let's say if all of that is capital gains, and they would pay tax at their graduated tax rate, which is much lower than your graduated tax rate as a high income earner.
Right. Yeah, what a fabulous example. And in my head, I'm wishing you had your whiteboard with your green marker. And I think that's the magic of when you go through examples like this, it really paints a picture of how it relates to the individual. So if anybody is looking for someone to walk with them through their specific scenario, Adelia's got her green marker and she'll be happy to pen it out for you.